From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Tuesday the 12th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alex, today, busier than yesterday, but not as busy as tomorrow.
Yeah, it was interesting that we did get sort of futures get hit overnight as we didn't have a lot of trading, right? And then all of a sudden now we're trying to claw our way into positive territory. The S&P pretty much flat on the day, but tech and consumer discretionary, we're trying to make a run for it. You still have yields higher, just sitting right around 156. The question becomes, what are bank earnings that are going to kick off tomorrow with JP Morgan, as you're referencing, plus CPI, busy morning? How does that kind of affect all of this as volatility is most definitely in play? Dollar at one point had a nice spike. Oil holding on to that 880 handle right there as the power crisis continues. But I feel your point, Guy. It does feel like a wait and see until tomorrow when we get the CPIs, you got the eco, and then you got the earnings of JP Morgan.
Yep, retail sales Friday as well. I think it's going to be interesting. We're getting data out of the U.S. economy right now. It's backdated to August, but I think it's interesting because it's the labor market. It's the job openings and labor turnover survey JOLTS that is being delivered onto the screen. And it's kind of a little bit of a mixed one, which is interesting. So what we had in July was a record, and July has been revised higher. So the job openings in July have been revised up from 10.9 million to north of 11. But the August number, Alex, is a little softer than maybe the market was looking for. So the market was looking for 10.9, maybe even going towards 11. But we've got a number that's a little bit softer than that. We've got 10.4. So the July number stronger, the August number a little bit softer. But I think you have to take a step back here, Alex, and look at what is happening. And that is that this data is still incredibly strong. You've still got huge amounts of help wanted signs basically plastered across America in terms of companies needing to hire. And we're going to see this in the earnings.
Yeah, and we'll get to this in just a second with Michael McKee. But in the NFIB, for example, one thing to point out was that 51% of these small businesses had positions they were unable to fill. So just like take that into account. Unable to fill. That's how much that demand is for labor.
It's absolutely incredible, and it's going to be interesting to see. As the IMF suggests that the inflation story is going to fade into next year, midway through next year. We'll see whether that happens, because it doesn't feel like it at the moment. Mike McKee, walk us through the numbers. What can we learn?
Well, you know, looking at the small business companies around the country, they're getting depressed by the fact that they can't find workers. We saw a big drop in small business confidence. It fell to its lowest since March in the month of September. And that's because, as you guys were just talking about, they can't find workers. Their 6-month outlook isn't any better. Things really looking down for these guys because they're having trouble finding people to fill the demand for labor, which means that they're starting to raise prices. You look at the number of companies that are raising prices, raising salaries at a record level. And as you can see, the number of people with job openings is at a record level. And we are just below a record level in terms of how many expect to raise prices to cover the additional wages. So you still see some pressures building from the small business community in terms of not finding workers, but having to raise prices to do that. It's something that we're going to be looking forward to hearing about from members of the Federal Reserve this week. Both of the topics that you were talking about is, you know, where do they think we are? Did the weak jobs report change their views, or does the strong JOLTS report keep them where they are? You've got a number of Fed officials who are speaking this week, and we get the minutes tomorrow of the last meeting to get set up for where we go at the next.
Well, and looking at that, I mean, that's 12 Fed speakers totally this week, plus we get a CPI tomorrow. Mike, what are we looking for?
Well, we're looking for a declining rate of increase. We're still
Declining rate of increase.
We're still seeing inflation rise, and we should see big increases in the headline numbers because of energy. The Fed, of course, looks past that. They'll be looking to see what's happening with the core index. And the great thing about the CPI is it breaks down all of the categories of inflation. So we'll see where inflation pressures are being generated and if they're in the so-called transitory categories.
All right, Mike, thanks a lot. Really appreciate Bloomberg's Michael McKee joining us. And we're going to hear more about what's on the minds of small businesses with Holly Wade, NFIB Director of Research on Bloomberg Television at 1 p.m. New York, 6 p.m. in London. That's one of my desert indicators, so I'm very psyched to hear that interview. All right, let's go to D.C. now, because House members returned to Washington to pass a bill to raise the debt ceiling enough to avert a default on federal payments for just about 7 weeks. Wanting the latest now from Emery Hordern, Bloomberg's Washington correspondent. Emery, House comes back. What happens?
Yeah, the House is on recess, and they'll either be here physically in person, some of them, but many of them are going to be voting by proxy, which of course was ushered in with the pandemic. So they're going to raise the limit so that we do not have a default. But Alex, as you mentioned, it's just for a few weeks. We are going to be dealing with this in a bigger showdown come early December. Senator Mitch McConnell procedurally allowed the Democrats in the Senate to have an easy vote on this, but he had written a letter to the president saying that will not happen again to December. So what I'd say what's happening right now in Washington when it comes to, one, the debt ceiling, but also when it comes to avoiding another government shutdown, is that these are just Band-Aids, and everything is leading up to early December when there's going to be another big showdown on this.
Anne-Marie, great stuff, as ever. Thank you very much indeed. AMH in D.C. Let's talk about what is happening with the earnings story. The industrial supply company, Fastenal, out with earnings earlier today. Really interesting, indicative stuff going on here. Abigail Doolittle digging into the numbers.
Indeed, Guy. It was a solid report overall, beating on both the top and bottom line by about 1% or so. But of course, the question, one of the big questions for this earnings season, what is the cost of rising material costs on margins? So first of all, let's take a look at here. And it turns out that the price pressure, for the most part, immaterial for the company. Material and transport pressure, yes, but the biggest point of pain, if you will, employees, 17% cost rising for employees. And if we take a look at the overall margin picture, yes, we're looking at a bit of a decline. But if you take a look here in the first quarter and the second quarter of 2020, where margins were 9.7% and then 9%, you can see steadily rising, really pretty strong, and now still well above 12.5% and above those prior levels, suggesting that the management of this company, Fastenal, the country's largest fastener company, glue, adhesives, and the like, that they're managing this pressure right now in a pretty strong way, Alex.
Yeah, Abigail, thanks a lot. Really appreciate it. That's a really good sort of indicator for the overall industrials. If sales hold up, then you can kind of manage the margin issue. All right, thanks so much, Abigail. Coming up, you got the IMF trimming its view on growth, warning of a, quote, dangerous divergence. We'll break down what that means with Geeta Gopinath, IMF chief economist. She'll join us next. This is Bloomberg. It is time now for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. General Motors says South Korea's LG Electronics has agreed to pay for costs linked to the recall of Chevy Bolt electric vehicles. And that recall was due to manufacturing defects in battery modules, and LG was the battery supplier. Now, GM says the agreement will offset up to $2 billion in charges. And shares of diversified energy fell as much as 21% in London. Bloomberg Green reported on the issue of gas leaks at wells the company owns in the American oil patch. Now, most of the gas wells Bloomberg visited were found to need repair. Diversified said the Bloomberg story does not reflect the positive environmental, social, and economic benefits stemming from the company's investment. GlaxoSmithKline is preparing to spin off its consumer unit. Bloomberg learned that a number of private equity firms are interested in what could be a $54 billion deal. Now, among them, KKR, Blackstone Carlyle Group. The Glaxo unit could also attract some of the world's biggest pharmaceutical and consumer good companies. And that is your business flash. And Guy, we'll leave the Glaxo thing on the side for a second, but it also just shows, like, that's a huge number for private equity and just how much money is still on the table in PE.
I think first, there's two things to say here, one of which you did that brilliantly.
Cold read,
Fantastic.
Thank you very much. Thank you.
Just amazing. So that, I think, is probably the bigger takeaway from all of this. The second thing is that, yeah, there's still loads of dry powder. There's still plenty of deals out there. It's interesting the SPAC story is fading a little bit, but private equity's got lots and lots of dry powder that it needs to be thinking about using and figuring out exactly what the right deal for that is. Maybe Glaxo fits the bill. Dave Wilson's got more on this story. Let's go to him now and talk about what's going on.
Yes, I mean, with this whole business about the consumer unit, Glaxo had been looking to spin it off anyway, so you knew some kind of a deal was coming. It's just a question of how it would look. And boy, I tell you, when you see 7 private equity firms in our reporting lining up to show interest in the Glaxo consumer business, it definitely gets your attention. And it's understandable. If you look at the consumer unit in the context of Glaxo, it's accounted for a greater percentage of revenue over the last couple of years. It's running about 30%, at more or less the level it was at last year in terms of its contribution to the broader company. And you are talking about a business that has a whole lot of names that people know. You look at the segments, you see Sensodyne, the toothpaste in their oral care unit. You see Advil, the pain reliever. You see Tums, in case you have a little heartburn. Centrum for vitamins. Theraflu as a treatment, and you put that all together. That's 95% of their revenue, basically. So, and it breaks up fairly evenly among those segments. So, they certainly have some well-established businesses, which, put it all together, you can kind of understand why the buyout firms would be interested.
Yeah.
I mean, relatively steady, a potential source of cash.
But it's not just that, right? That's moving the Glaxo stock right now?
No, it's not. I mean, because Glaxo has this relationship with the German company CureVac that's been working on COVID-19 vaccines. And the story out of CureVac today is that they decided to drop their first generation vaccines in terms of what you would call second generation shots, perhaps a combined COVID and flu vaccine. So, it's something certainly that Glaxo would want to be a part of. And the real challenge from CureVac's perspective is how long it would have taken, maybe 8 months for Europe to sign off on the first generation. And so they decided to drop it at this point and move on.
All right, Dave, thanks a lot. We really appreciate it. Thanks for the hustle, too. Bloomberg's Dave Wilson joining us there. We'll get to Gita Gopinath in just a second from the IMF chief economist. This is Bloomberg.
Live from London, I'm Guy Johnson. Alix Steel, of course, over in New York. This is Bloomberg Markets. Let's talk about what we're getting from the IMF today, trimming its global growth forecasts for this year, not next year. It's basically saying the global economic recovery losing a little bit of momentum. And interestingly enough, it's becoming dangerously divided. Their words, not mine. So basically, let's talk about what we've got here. So global growth slowing a little bit this year off what was expected, but it's still really, really high. So basically, we're going from 6 to 5.9, but they are still predicting at the IMF that we are getting a significant post-pandemic bounce back. It's just moderating a little bit. We all know why. Supply chain constraints, what's happening in the energy story, all factors into the mix. Next year, 4.9 next year. But it's this idea that we get this, quote, dangerous divergence, Alex, in terms of the growth data. What you're seeing is a clear division in terms of vaccinated, not vaccinated, in terms of exposure to inflation. And what we're going to see on inflation is that it's going to pick up and then moderate, according to the IMF. A lot of people, central banks certainly saying that at the moment. Will it come true? But this idea we get this sort of dangerous divergence, I think, is something that we're going to need to dwell on, because we think here that it feels like the vaccine story is kind of in the rearview mirror. For many, it's not.
Yeah, for us now, the headlines are all supply chain issues, not necessarily vaccine issues. So let's get some more insight now. In a Bloomberg First interview, Gita Gopinath, IMF chief economist, joins us now. So this dangerous divergence, can you talk me through kind of the number one thesis behind that? And what is the downside risk to your outlook?
Hi, Alex. Always a pleasure to join you. When you look at our projections and you look at the advanced economy group, next year we project advanced economies to be back to pre-pandemic trend paths, where they would have been in the absence of the pandemic. But if you look at many emerging and developing economies, we're looking at very significant scarring. Of the magnitude of 5% of their output lost relative to where they would have been, even 10% relative to where they would have been. So this is the divergence that we are extremely worried about. And it has two factors. One is the highly inequitable access to vaccinations, especially with low-income countries, less than 2% vaccinated, and the fact that policy support has been much larger in advanced economies as compared to many emerging developing economies.
In terms of what's happening in the developed markets, Geeta, the fear at the moment is that we are going into either a inflationary world or a stagflationary world. You don't see that. What gives you confidence that inflation is going to fade as we work our way through next year?
So, Guy, firstly, when you look at the facts in terms of how countries have rebounded back to pre-pandemic levels, and especially advanced economies back to pre-pandemic trends, this is not a bad recovery. I mean, this is a strong recovery that we have seen. And right now, we still have the global economy projected to grow 5.9%. In terms of inflation, our view is that for most countries, by the middle of next year, you're coming back to more typical pre-pandemic levels of inflation. There are upside risks, and some of the countries, the risks are bigger. I would say the US is one such country. But as of now, many of these features look transitory. Even for the US, if you look at month-on-month core inflation, it has moderated over the last few months. We'll see what happens when the data comes in tomorrow. But again, in terms of the pressures, we're seeing supply-side pressures. We're seeing commodity prices go up, energy prices go up. Again, if you look at futures prices, all of that is expected to revert by the middle of next year. Much of that is expected to revert by the middle of next year. So again, there are these transitory forces. And as long as we see inflation expectations remaining anchored and no wage price spirals, we expect to see a return to normalcy by next year.
Geeta, what would have to happen for you to think that those inflation expectations weren't anchored? Because the 5-year forward break-even is the highest level here in the U.S. in 4 years. In the UK, break-evens are over 4%. I mean, the path of least resistance feels like it's becoming a stickier environment for inflation.
So, Alex, firstly, we do want inflation expectations to be at a particular level consistent with inflation mandates of countries. So after inflation expectations came down quite a bit last year, we should be glad to see it moving back up to the levels at which we'd like them to be. We would like to see broad-based inflation again at the kind of levels we're used to seeing. Now, the question is, if that spirals out of control and you said ending up with very high inflation numbers, much above the comfort range of central bankers and of people in general, and there, we're not seeing that yet. And again, we're looking very closely at what develops in labor markets, whether we're seeing broad-based wage inflation, we're seeing what's happening with shelter inflation, whether there's a pass-through from housing prices to shelter inflation, what's happening to long-term inflation expectations. I think these three sets of indicators are what will give us some signs of where we're headed.
Geeta, so is your suggestion to global central banks, to advanced country central banks, that they should look through any inflation they're seeing at the moment? Because I listened to the central bank just over the road from me here, the Bank of England. It sounds like that's not going to be the case. They're not going to look through it. They're going to react to it. Is that the right way to deal with this? Is it too early to be tightening monetary policy?
And central bankers should care not just about what's happening to inflation, but also about what's happening to the economic recovery. So again, there are countries like the US where we've seen a very strong economic recovery. There is not that much distance more to cover. And therefore, you have to ask yourself the questions about, is now the right time to withdraw support? Tapering asset purchases seems like a reasonable thing to do in the near term. In terms of rapidly tightening monetary policy, I would say you have time to wait and see how these inflation, what do we see on the inflation front? Kind of give it some more time to see these developments a little more closely. But again, I think our headline message is also to be extremely vigilant and to be ready to move quickly if you have to.
So if the path of least resistance for some of the developed central banks like the BOE and the Fed is to move slowly but to still move, Does the IMF have an idea of what the impact will be, as in taper tantrum in the bond market, a tantrum in the equity market? What's the best guess?
Our best guess, which is what is in our model forecast, is that this will be relatively well contained. So there will be some tightening in financial conditions, but nothing to throw off the recovery. So this is why we expect the global economy to continue to grow next year at the rate of 4.9%. The problem would be, of course, if there are policy accidents that happen in miscommunications that then end up with sharp increases in risk premia, sharp increasing in borrowing costs, not just for advanced economies, but for emerging and developing economies that they rely a lot on external finance. That could trigger a much more severe downturn.
Geeta, what impact is China's increasing regulatory crackdown likely to have in terms of its economic growth? What impact is common prosperity likely to have in terms of economic growth? I see you've downgraded your forecast for that part of the world, but I'm curious as to whether or not you think this regulatory environment continues, whether or not this is something you are projecting forward and will have a longer lasting effect.
The regulations, putting in place the regulations to rein in asset bubbles or excessively easy financial conditions is something that's been going on in China since last year. And it is why we have also downgraded our forecast. We did it in July, and we've done it some more now. We've seen developments in the property sector. The property sector is a very important part of the economy for China. We've seen developments with Evergrande. As of now, our view is that the Chinese government has the tools to be able to contain the fallout from particular property developers, the problems that they're facing, and to prevent it from becoming a widespread phenomenon. So while we do see growth slowing in China, we are not projecting in our baseline a sharp slowdown, which will then, of course, have repercussions to the rest of the world. But that is what the baseline is. These are very uncertain times, and there are financial risks.
Geeta, before we let you go, I wanted to get your help in addressing the doing business scandal that has erupted over in the IMF and Kristalina Georgieva. Do you feel like your research is going to have a credibility problem? And what do you feel like you need to do to backstop it?
So, Alex, as you saw, the board came out with a strong statement expressing full confidence in the managing director. The issue about the data had nothing to do with the IMF. It was about the World Bank's doing business report. We place incredible amount of importance on data integrity at the IMF. We have many checks and balances, multiple departments, multiple economists reviewing our data and forecasts. So I feel good about where we are.
You have been put under no pressure to make the data fit the narrative that is being delivered further up. That's never happened. There's no incidence of that happening at the IMF.
Absolutely not. I have personally never faced that pressure.
Geeta, thank you very much indeed for your time today. We look forward to the next installment of your economic outlook with a great deal of interest. Geeta Gopinath, IMF Chief Economist, greatly appreciated. Alex, it's this belief in transitory inflation that I think is fascinating at the moment. The market is increasingly of the view that that narrative needs to be questioned, and we've seen that in the data. You've certainly seen that in the rates market as well. Yet the IMF, many central banks continue, the Bank of England looks like an exception, to voice the idea that it is going to be transitory, that we will get back down to more normal areas. But as the labour market story develops, the energy story develops, economic growth story develops, it feels like it needs to be put under pressure, under the microscope.
I think that's part of the problem is we just don't know. I mean, they're just trying to bide some time and maybe not make a mistake. And also to withdraw whatever kind of stimulus they can to then give some more firepower for when it's actually really needed, and that they don't actually know the answer to that question. And that transitory, if it means 18 months, that's a different kind of story. What are the aftermath effects of something like that? Now, there are potential signs that maybe some of the port issues may be easing just a touch. But what does just a touch mean? Does that really have a big impact?
Well, I'm curious to see what happens post the holidays, whether or not actually the demand story that is being delivered in front of the holidays will fade a little bit. But your point about raising rates for reasons other than inflation, I think is really interesting. And I was having a conversation about this earlier on today with somebody, talking about the idea that maybe the Bank of England is looking to raise rates, as you suggest, not to deal with the short-term inflationary issue, but actually to get ready for the next downturn, that they want to have some ammunition back in the locker that they can use when that point comes, because it will at some point, and rates are super low. The Bank of England's a reasonably conservative central bank. Maybe he doesn't want to mess around with the negative rate stuff that they've led us down the garden path on.
But I have to wonder if 15 basis point move does that really count as ammunition?
Well, maybe you get a bit more than that. Maybe you get up to the kind of terminal rate of around 1%.
Maybe.
We're at 10 now.
Yeah.
So we've got a long way to go, but there's the potential to get to there.
Which then I
Maybe
think
that's what the Bank of England's actually signaling.
But then we have a bigger problem. Then we're at peak monetary policy. Then we've kind of hit it. There is nowhere. Where do you go from here? I think that's a bigger issue then.
Well, I think you go gradually, but if Morgan Stanley's right and this is an accelerated cycle, then there's a downturn coming at some point.
All right, well, let's get to that whole perspective. So you have many individuals calling for more stagflation, that call getting louder. There's some naysayers, but a lot of them really feel like that's in the cards. Nouriel Roubini Macro Associates CEO, and Jan Hatzius of Goldman Sachs spoke about this over the last 24 hours.
We have a significant slowdown of growth, and we have a meaningful increase in headline and core inflation. That's the situation, in my view, is going to be persisting, not just a one-quarter phenomenon, but persisting for several quarters.
I think in the near term, it's real if you just define stagflation as deceleration in growth from the extremely rapid pace that we had a couple of quarters ago, and much higher inflation than we've had in several decades.
On the flip side, you have RBC, Tom Porcelli, talking about the fact that stagflation is purely a distraction. While our next guest sees one particular sector that's leading the economy into direct inflationary and potentially stagflationary pressure, here to break it down with us is Karen Karnal-Tambor, Bridgewater Associates co-CIO for sustainability. So what are you watching? What do you see? Oh, I think you might be on mute.
Oh, apologies.
Oh, there you are. Okay.
Alex, the most important thing is that it is tempting to think any one sector is the whole story. The broadest thing going on is just demand is clearly outpacing supply, and the massive inflation that central banks have provided are going to create these very significant inflationary pressures everywhere. And any one sector is, its own sector, and it's tempting to say it's just unique circumstances there, but it is broad. That said, the one sector I think is really worth calling out is the energy sector, because policy intentions here are much clearer as is specific to that sector. Meaning all around the world, policymakers have said, we'd like to see an energy transition. They've made different goals and different, kind of pledges in that direction. And the particular tools they've chosen, you can do it all kinds of ways, are mostly either to price carbon, either through a cap and trade or a direct price, or through directly limiting supply, saying, we're not going to finance more coal. We're not going to do any more of this. And so those are, by definition, inflationary or stagflationary. You mean to create those incentives in order to persuade people to shift away from carbon-intensive things.
Karen, do you think the governments are going to back off that? I was reading a report earlier suggesting that maybe the UK could be in a position, because carbon prices have been so high for so long, that there is the option maybe to issue a few more to maybe take some of this pressure off, particularly when it comes to energy inflation.
Well, I think the most tempting approach for governments is to go down fiscal and monetary together. In other words, use stimulus policies to transition away from carbon rather than more stagflationary ones. So instead of taxing carbon, you can give lots of incentives, make it really cheap to make green energy, or literally spend federal budgets on refurbishing things, on new technologies. That's a way that, it's inflationary, but it's more broad to the whole economy. It's not as specific. It's not as regressive in terms of who pays for it. That to me seems like the most tempting thing, rather than backtrack on, kind of the whole idea of transitioning the energy economy.
What part of that, though, needs to be rethought right now in the middle of the energy crisis?
Well, look, there's short term and there's medium long term. So in the short term, governments are going to do all the short term levers that they need. And I think that, in the UK and Europe where it's most acute, they're already looking at, just take government money very directly and try to support whoever is squeezed by this, as well as just bring supply online any way you can. And those are the short term levelers. That's not the most important. The more important question is, look, these are long term goals. These are multi-decade goals the governments have in place. And will they, set up for the longer term, figuring out how do you get enough supply of the renewable energy that you want? How do you get enough incentives there without going down a more stagflationary path?
In terms of the near-term demand destruction that could come as a result of all of this, there's talk of turning factories off. There's talk of sort of hitting consumers. Karen, in terms of balancing what is happening in the long term with the short term, how do we do that? How do we avoid near-term demand destruction to achieve these long-term goals?
Well, in the near term, there will be some demand destruction that happens as a result of this. And not only in energy, everywhere. You look at, you can't get enough ships to ship your things. You can't get enough workers to, run the service economy. You can't get enough truck drivers. You can't get enough, semiconductors. All of these issues are going to lead in part to higher prices and in part to lower growth, because you literally won't be able to have the growth that people want to have. In large part, though, policymakers wanted these outcomes. They wanted to have repaired balance sheets, strong income, strong demand coming out of COVID. And I think they were willing to accept somewhat higher inflation, and I think that's what they're getting.
Okay, so how do you hedge for it? What's the best? What's the best hedge? I feel like nothing's really working right now, unless you were maybe long energy stocks.
Well, as an investor, I'd say that almost every portfolio I look at, what it really has very little of is things that you think are going to be inflation hedges. And in today's world, you can easily look and say, look, you can't have just one inflation hedge, because inflation could show up in lots of different places. And so if you only end up having, one commodity, one energy stock, one company, you have all this idiosyncratic risk. How's that particular company going to be regulated? What are its different things going to be? And any one commodity could be more squeezed or less squeezed. So you really need a collection. I think one of the easiest switches investors can make is to switch some of their nominal bond holdings to inflation-linked bonds. It's very simple. You're literally going to get paid whatever CPI is. And, in most countries in the world, that's just not priced to be all that high for all that long. The upside risk seems like one that investors don't have a lot of hedges against. And it's an instrument that will just pay you that.
They're quite expensive, linkers, right now. Tips, call them what you will. Do you still think there's value there?
Well, I think that what you should do is divide the pricing in some sense to the pricing that's embedded in, both treasuries and in tips, which is, what you call the real yield, versus the piece that's inflation. And so if you have a treasury, the treasury is too expensive to begin with. And so if you're holding a treasury, you have this issue of whether or not rates are going to be raised faster than already priced in. But if you're already holding a treasury, I think you might as well, instead of only taking the risk that the Federal Reserve will raise rates faster than expected, get paid on CPI, whatever it comes out as. So the expensive part, I'd say, is also in the treasuries. The part that you're going to get paid for in terms of CPI, it's not priced to be that high. Inflation is just not priced to be all that high relative to what it might end up being. You don't need a lot of outperformance in terms of inflation to get paid on that.
At the same time, we are still looking at an environment that feels very TINA to me. Maybe a little bit different, right? Like maybe retail's going in and buying some puts and individual stocks. But overall, it still feels like if the stagflation narrative, or if inflation slows down stagflation slows down central banks, it's still a TINA scenario. Is that true? Is the search for yield going to continue to be that strong?
I agree with you. Broadly, I'd say that we shifted from what was an extremely favorable environment for risky assets to something that's more kind of neutral. It was just an amazing time to hold risky assets, and we've been spoiled by that. And now that's no longer the case. You're no longer going to get a flooding of liquidity by central banks. There's just obviously accelerating constraints on policymakers in the form of rising inflation pressures, capacity constraints that they're going to have to pull back to some degree. And so the environment we were in, it was just a great time to be in risky assets, is just a lot more neutral today.
In terms of what we should think about going forward, Karen, do you think central banks are going to protect the equity market in the way that they have done? As you say, they provided huge amounts of liquidity on the upside, but if we get a down move, do you think central banks will alter behavior as a result of that? Where do you think the trigger for that is? Where is the Fed put?
Look, I think that central banks aren't going to care about small moves in the equity markets, and they shouldn't. It just doesn't make sense for them to do that. But where they are today, which is a really tough situation for them to be in, is that in order to slow the economy to the degree they might need to, the effect on asset prices could be quite significant. And so they could find themselves in a pretty tough spot where, durations are so long, rates are so low that a pullback in liquidity has kind of a disproportionate effect on a lot of these risky assets. And so they might have to trade that off when they want to slow the economy. The effect's going to be more on financial assets in many ways. It's going to be very hard to slow the economy exactly because they were just so successful at the mix of policies they had. When you literally send people checks and they get them in their house and now they have great balance sheets and great incomes and they're sitting on these savings, a small change in interest rates doesn't really change that self-reinforcing nature of the recovery. So you have this very self-sustaining, self-reinforcing recovery. So the Fed eventually, when it wants to tighten, might have to live with tougher consequences on asset prices than it's had to in the past.
Karen, it's always a pleasure. Thanks for sharing some of your time with us today. We greatly appreciate it. Karen Campbell of Bridgewater Associates. Thank you very much indeed. Lord Frost, the UK Brexit Minister, is speaking right now. He's talking in Lisbon. He's delivering what, as expected, is a fairly damning indictment of his perception of the Northern Ireland protocol. He says that the protocol is basically shredding the Good Friday balance. This, of course, hugely of concern in Washington, D.C. The president has made his views of this all very clear. But Lord Frost says the protocol, Alex, isn't working and has lost consent.
Well, apparently, the EU-UK are heading into a crucial few weeks for Brexit. I thought that was like a year ago, and then a year ago, and then a year ago, and then a year ago, and a year ago. The cable rate, I should point out, right around the lows of the session, 135. Guy, RBC sees 130, as there is some risk to all of this as we move forward.
Well, there's a danger that we're making a policy mistake over at the Bank of England. I think it's certainly a factor that the market is increasingly concerned about. But there is the possibility that we've basically, and we're about to celebrate, remember, the kind of the one-year anniversary. It's not that far away of the Brexit deal being done. I say celebrate. But there's a danger we basically go from a deal being done to a trade war within that very short period. Particularly if Lord Frost basically kind of moves the UK in the direction of tearing up the Northern Ireland Protocol and triggering Article 16. As he says, it's going to be an interesting few weeks.
Yeah, I also wonder if France is going to use its power, literally its power, leverage over the UK too, if that sort of comes into play on the sidelines. Anyway.
We'll talk about that with the ambassador a little bit later on.
That's
the ambassador to the United States from France joining this show in a few minutes' time. This is Bloomberg.
Launch infraction proceedings against us earlier this year at the very first sign of disagreement shows why these arrangements are so hard to make work in practice. But it's not just about the court. It's about the system of which the court is the apex.
This is Bloomberg Markets. I'm Laura Wright. You're looking at a live shot of the principal room. US Senator Chris Murphy of Connecticut. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Laura Wright. GlaxoSmithKline is preparing to spin off its consumer unit. Bloomberg's learned that a number of private equity firms are interested in what could be a $54 billion deal. Among them, KKR, Blackstone and Carlyle Group. The Glaxo unit could also attract some of the world's biggest pharmaceutical and consumer goods companies. In the UK, a parliamentary report found that Boris Johnson's government made serious mistakes in the early handling of the coronavirus pandemic. Lawmakers say that imposing a full lockdown more quickly would have saved lives. A spokesman said the government never shied away from taking quick and decisive action. The European Union drew record demand for its debut green bond. There was more than $156 billion in orders today for a sale of almost $14 billion of securities. The money will be used by EU nations for energy efficiency, clean energy and climate change adaptation. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Guy, Alex.
Yep. So anyway, the green bond story, Guy, I think is really fascinating because it shows how strong the demand is. What I really want to know going forward is the greenium, like how much you actually pay up for it, if that's sustainable. Like just how willing are people to pay up for something that's greener, whether it's stuff like toothpaste or whether it's going to be a green bond?
Yeah, if you've got green toothpaste, that's all you.
It's
I don't want
Greenly.
green
It's
toothpaste.
toothpaste Greenly, Guy.
I do not want, I will take my white, blue, red, whatever colours I'm going for, but green may be a stretch too far. Though maybe it is a bit minty. Look, I think the answer to your question is a lot. A lot of people have increasingly got mandates that require this. There is a huge amount of demand. I think one analyst called today's auction a riot. Basically, everybody's clamouring for this stuff. So the expectation, judging by what we've seen thus far, is that we are going to see potentially the greenium rising. It may go from 2-3 basis points out to 4-5, maybe 6 basis points. This is a super cheap way for governments to borrow, which will encourage them to increasingly go down this road as well. The Greenly challenge is also obviously one that is going to be huge for the aviation sector.
Nice turn.
We are awaiting. Yeah, I'm trying to make that work there. I'm not sure it's entirely relevant, but anyway, Boeing's third quarter delivery numbers are about to come out. We've already had Airbus numbers this morning as well. Remember, Airbus is targeting 600 deliveries for this year. I think it's about 170, 176 short at this point. So we're going to have to see some big delivery months. But the supply chain potentially having an impact. I spoke to the management of Airbus and they talk really clearly about what's happening in the supply chain. Kai von Rumer is Cowen's senior analyst. He has an outperform rating on Boeing with a 290 price target. Kai, thanks for your time today. We're waiting for these Boeing numbers to come. Clearly, Boeing is having to go through a much more accelerated delivery schedule than Airbus is at the moment as we move away from what's happened with the MAX, as we move away from the ongoing issues with the 787. Just walk me through what you're expecting Boeing to be able to deliver this year, because this is cash flow crucial.
Well, I think they're going to be probably light on both the 737 and the 87. As you know, they haven't delivered any 87s for months. I think the Wall Street Journal indicated they would start delivering again in late October. My sources are telling me it might be a bit after that. And secondly, on the 737, the deliveries in August and September both were a little bit disappointing, not entirely clear why. I think one of the issues is China, but those certainly are a bit disappointing.
So Kai, is your base case as steady as she goes, as in the supply chain issues don't get worse, the energy and power issues don't get worse, COVID doesn't get worse? Those are factors that will impact all of the supply chain lines. How do you factor that into sort of those numbers for a Boeing?
So when I upgraded Boeing, the idea was that they could do a little over $20 in cash flow in 2024. Obviously, if COVID gets worse, that's probably unrealistic, but it does look like the numbers for COVID are coming down. It doesn't assume a major glitch in the supply chain. Remember, the supply chain is going at a much higher rate than currently we're forecasting for when you get out to 2024. So that should be doable, but the real issue is that Boeing has to start delivering 737s and they have to start delivering 87s, and China needs to come back into the mix.
Just to stay on the supply chain issue for just a moment, I was speaking to Guillaume Faury at Airbus a couple of weeks ago, and he was talking, really for the first time that I've heard him talking in this way, about his concerns about what is happening within his supply chain. The supply chain is not his. He does share it with Boeing, and many companies that will be providing services for both companies are being affected at the moment. Kai, in terms of the near-term problems that both of these companies could be facing, how severe could it get? I'm not just talking about materials, but the ability to hire engineers, technicians. Where do the problems lie right now?
Well, first, there's a little difference between Airbus and Boeing because Airbus wants to go up to 70 per month. That's a rate they've never been at. So Boeing is really going up to rates they've already achieved. They basically kept around most of their employees. So, you know, they're bearing the cost of that now, but I think they have the manpower to get it done. you know, you never can totally tell about the supply chain. That's sort of a factor across industries, but and you only need one supplier to be late. But Boeing has experience managing it. I think their targets are realistic. Well, I will say, with the exception, I've been skeptical of 31 a month that they've been talking about for early next year, simply because you know, it looks like they have not been delivering enough planes now. They still have approximately 370 completed MAXs in their inventory. So I think getting to 31 per month, which is what they've said they hope to do early next year, I don't think that's going to happen.
Kai, walk me through the other end, which is the end user demand. And I wonder how it works when you have issues with ramping up capacity. Southwest, perfect example, and they don't have the staff to meet the kind of demand that they're seeing. How does that filter back through Boeing?
Well, the way it filters back is they'll call Boeing up and say, you know, deliver them a bit later. So clearly all these issues, if the customers don't have, you know, the folks to fly the planes, that's an issue. If you have supply chain constraints, that's an issue. It's basically, you know, one large cycle.
All right, thanks a lot, Kai. We really, really appreciate your flexibility and for jumping on with us today. Kai Van Rumer, Cowen senior analyst. And Guy, let's just stay on planes for just 1 second. Southwest will be
happy to.
Yeah, no problem. Southwest will comply with the federal vaccine order over a Texas ban. So the federal order supersedes any state mandate. Texas tried to get out of a vaccine mandate, and it turns out they can't. So they're going to comply with that federal vaccine order over state ban.
Yeah, this is interesting because in some ways this also goes to what is happening with the Texas story, which obviously is where Southwest is based, and what is happening with the banks. And the banks basically are finding themselves in the crosshairs as the state decides that banks that obviously have taken a different approach when it comes to gun control, etc. Maybe they don't get to play in the muni bond market in the way that they would, and some of these banks are basically just walking away. So it's interesting to see ultimately kind of where Texas sits in this story. You can then draw a line to Tesla and think about what is happening there as well.
Yeah.
Does this march to Texas stick, is my question.
If there's enough to kind of shift the narrative in Texas, maybe? I don't know, we'll discuss. This is Bloomberg. All right, time now for Bloomberg Business Flash to look at some of the biggest business stories in the news right now. In China, Tesla overcame a broad slump in overall car sales. The EV maker's shipments of China-made cars to the local market rose for a second month in a row. More than 52,000 Teslas were sold. Meanwhile, China's overall auto sales fell 17% in September. And the travel rebound in the UK is picking up pace. You got EasyJet saying it will boost capacity to about 70% of 2019 levels this quarter. The lifting of travel restrictions has led to a surge in bookings to places like Egypt and Turkey. I know Guy's not yet on a plane, though. All right, Citigroup also managing to irritate one of the bank's most prominent detractors. 3 of CEO Jane Fraser's lieutenants are eligible for as much as $5 million in bonuses each if the bank's stock hits certain targets, and they meet goals in a transformational program. Now, Wells Fargo analyst Mike Mayo says Citi didn't spell out the targets. In his words, that's like charging us for dinner before we know if we're going to get hot dogs or caviar. And that is your business flash. You gotta love Mike Mayo. Caviar, hot dogs, $5 million bonuses. Yeah, kind of, they're all the same.
Yeah, it all goes into the same pot, doesn't it? It just tastes a little bit different. Mike's going to join the team a little bit later
That'll
on.
Be fun.
Looking forward to that. That's going to be an interesting conversation. Tie, no tie, we'll see. Anyway, Mike Mayo coming up, 2:30 p.m. in New York. This is Bloomberg. The close is next.